Hello, welcome back to Mining Network. Today I'm joined by Peter Schiff, the founder of Euro Pacific. Thanks for coming on. Just to begin with, obviously gold's down about 3% today. I wouldn't mind just touching on that. Usually I don't really pay too much of attention to the gold price on a daily basis. I'm pretty happy with where we are. But what just set the scene in terms of what's behind it at the moment. Are we still seeing some selling, some profit taking? Is part of this to do with the minerals deal that we saw announced yesterday, or is there a bit more to it with, or really more of this fallout with Trump backing off of Jerome Powell and the market being a bit more
Well,
happy with what's going on there?
it's well, it seems to me like a lot of the trading recently is kind of news driven headlines, not so much the fundamentals. And so I think the newer headlines are, oh, maybe we're going to get some kind of trade deals. Maybe the trade war is going to be ending soon, or the tariffs won't be as high. Plus, you've got some good earnings now that came out today from Microsoft, from Meta. So you're getting a big rally in the tech stocks. And over recent months, there's been a pretty strong negative correlation between gold and those tech stocks. It's more of a risk on, risk off trade. And since everybody is now buying back the risk assets, many people are selling the risk off assets that they bought, which was pretty much gold. It was the only risk off asset that was kind of left standing. Everything else was going down, including treasuries. So I think you're getting some profit taking based on those headlines. But, I think the fundamental story for gold has never been better. I think the momentum is there. I mean, no bull market goes in one direction without any corrections. I think the economic news, including the economic news we got today, was very weak. And I think the US economy is in recession. It's been there for a while. But I think the labor market is going to roll over and the economy is going to continue to weaken. And ultimately, we're going to get rate cuts. We're going to get a return to QE, I think. And all that is very bullish for gold.
Well, on rate cuts, obviously Jerome Powell was having a lot of pressure from Trump to cut rates. Pressure has died off a bit now because I think there's a lot of market influence there, people panicking. You were saying there that you do think that the rates are going to cut. I know in the part I have seen you over the last couple of weeks say that you think they should increase rates. Why do you think they're going to cut them?
Well, rates are too low. I mean, that's one of the reasons gold is as high as it is. It's because inflation is going to, keep growing. The Fed never raised rates high enough to put out the fire. We're in accommodative territory now. I mean, the Fed claims that its monetary policy is restrictive, but credit growth continued and accelerated during the entire time that the Fed claimed it had its foot on the brake, which obviously it didn't do because governments kept going deeper into debt, households were going deeper into debt. They never stopped the credit expansion, which is the inflation. It's not just a money supply that's inflation; it's the supply of credit. And the Fed has been an engine for easy credit, and that's helped push up prices, and that's going to continue. And so the gold market sniffs that out. The gold market realizes that the interest rates are negative in real terms because the Fed is, the rates are not high enough to compensate for the rate of inflation. And so that's one of the reasons that central banks are holding gold more than treasuries. And I think that trend is going to continue as the de-dollarization efforts pick up steam as we move forward during the year.
So is this a change of course from Powell you're foreseeing because of the economic data that we've seen today or recently in terms of the US likely is going to be going into a recession? So more of a shift on focus on growth versus
Yeah,
versus
well,
anything
it's
else.
both. I mean, the growth's going to be weak. In fact, we're going to be in a recession. I mean, we've already started it because the U.S. economy, it's a big bubble, but it's based on consumer spending, which is fueled by debt and trade deficits. So, in order for consumers to spend, they have to have access to credit and access to goods produced in China and other countries. Well, we've basically cut off that supply chain. The goods are not going to be coming in to the country, and so if the goods aren't here, we can't buy them. And so all that economic activity that is related to that, trucking, with transportation, the people that work in retail, you know, there's going to be a massive recession in, the consumer spending part of the economy, which is like 70% of our GDP. So, this could actually be a bigger chain disruption than COVID. We'll see. Um, but the goods that Americans buy are just not going to be on the shelves, so that they can't buy them. And if they can't buy them, then we can't sell them, right? So a lot of jobs are going to disappear, and that's going to be showing up in the numbers, and we're going to be in a recession.
What do you think Trump's game plan was when he announced Liberation Day, and how much do you think he's following this Hudson Bay sort of research report that was released back in November?
I have no idea if they have a game plan. I mean, they may just be winging it. They just react to the headlines, because there's no real path to victory here. We've launched a trade war that we can't win. So the only question is, how do we find a graceful way out? How do we, contrive some kind of fake victory from the jaws of defeat? I don't know, and I don't even know if they realize that we can't win the trade war. Right? I have no clue. I mean, there's a lot of nonsense that comes out of the Trump administration, because a lot of the guys that are really pushing Trump towards this trade war and protectionism, they're the same guys that are pushing Bitcoin. So, I don't know if they're pushing this because they know it's going to hurt the economy and hurt the dollar, and they think somehow that's going to benefit their Bitcoin. I don't know. But maybe they're just, foolish, and they actually believe it's going to work the way they believe Bitcoin is going to work.
Yeah, maybe. A part of me, when I saw the Liberation Day, and then I saw the sort of the backtracking and the big blowout with China going back and forth on increasing tariffs. Part of me thought that they did have a plan, um, but now they've, like you were sort of saying, they've had to sort of change course and try and make a win out of a failure. It's one of those wins that, and it's something that they've been talking about now, is trying to organize as many free trade agreements in this 90-day period as possible. And if that is the plan, is that actually going to help or change anything?
Well, first of all, I mean, trade is on balance pretty free globally. I mean, it's not purely free. Most countries have some tariffs. Usually it's on certain goods where there is a politically organized faction within the country that has been able to basically bribe the government into implementing those tariffs so that they can benefit at the expense of the rest of the country that isn't politically organized to fight the tariffs. But a lot of that has to do with agriculture, farming, and a few other goods. But by and large, like one of the countries that they're talking about that we're close to a deal with is South Korea. Oh, okay. Well, what can we get out of South Korea? Because if you look at what their tariffs are, the average tariff rate on US goods coming into South Korea is 0.75%. That's the average, right? Some tariffs are a little higher and some are zero. But in total, I mean, they're less than 1% tariff. So even if they drop all their tariffs, is that really going to make a difference to our trade relationship with South Korea? And by the way, last year, before Trump jacked the tariffs up, our tariffs on goods coming in from South Korea averaged 3.3%. So we were tariffing South Korean goods 4 times as much as they were tariffing our goods. So, I mean, if we have a deal, are we both going to go to zero? I mean, wouldn't that be a win for them? Because we'd be lowering our rates a lot more than they'd be lowering theirs. So I don't even know, like, what are we going to gain from South Korea? And most of the countries that they're talking about a deal with have very low tariffs to begin with. So this is all a bunch of smoke and mirrors.
And what about the idea that, okay, fair enough, some of the tariffs are quite low, but obviously we have heard the administration, especially point out with China, for example, currency manipulation, subsidies, something that the mining industry focuses on quite a lot is when you look at the critical minerals side, they have quotas, for example, on things like rare earths, where even if they're not making money, they'll carry on producing and really has an impact on that market. And then there's other aspects like VAT and sales tax, for example, that the Trump administration have been talking about. Um, does I think this is more in particular with China, but does that unfairness aspect, is there not some rationale there to try and change things?
It's not really unfair. I mean, to the extent that any country subsidizes a particular business, it's at the expense of another business. And the losers are the residents of that country. So if China decides to subsidize a business that, China's losing, not America. If the result of those subsidies means that we get to buy something on the cheap, we win. China loses because they're providing us with that subsidy. But we have subsidies too. I mean, there are industries that we subsidize. Our tax code subsidizes certain industries. We shouldn't do that either. That's bad for us, and the Chinese subsidies are bad for America. But the huge trade deficit we have with China is not because of Chinese subsidies, because there are a lot of other countries that have trade surpluses with China, and they face the same subsidies that we do. So the problems are in America. It's not in China. China makes a lot of stuff, but it doesn't make our problems. Now, one of the non tariff barriers that they talk about is exchange rates. They say that the rest of the world, their currencies are too low, and that gives them an edge, and so they want those currencies to go up. But at the same time, they say that we have a strong dollar policy and we want a strong dollar. But now we're blaming other countries for helping to keep the dollar strong. They're saying you're cheating by strengthening our dollar. You need to weaken our dollar. Well, okay, well, but then we have a weak dollar policy, right? If we want everybody to weaken the dollar, how is that consistent with the strong dollar policy? So, they're speaking out of both sides of their mouth. But I do think that one of the problems and one of the reasons that we have these big deficits is because the dollar is so overvalued. And that's been a consequence of the dollar's role as the reserve currency. But we have taken advantage of that overvaluation. We have exploited it. We use the overvalued dollar to buy goods that we don't produce, to live beyond our means. So we are the ones benefiting from global trade. The rest of the world is subsidizing our profligacy.
No, I do agree with a large portion of that. The only thing I'm trying to get my head around, I guess it depends on what your goals are in terms of the US, right? Because like you were saying, if China is subsidizing, let's say rare earths or anything, say batteries, and the benefit there is obviously cheaper batteries for the consumers who are in the US, right? But if your goals aren't about cheap goods, they're actually about employment and manufacturing and bringing things in house, that isn't a positive for the US.
Well, I mean, first of all, China can't subsidize all of its industries because the money has to come from somewhere, right? If you subsidize one industry, you're handicapping another one because the government just has to move the money around, right? So somebody is going to lose in China in order for a particular company to benefit. But again, we do the same thing with our tax code and our government corporate welfare plan. So we do, we say this company gets a special tax break, this one doesn't. So we do the same thing. So it's the pot calling the kettle black when the U.S. says, "Oh, China, you're subsidizing company." We do the same thing. But what our goal, right? Our goal should be to eliminate these trade deficits by going after the root cause of the deficits, which is our excess consumption, our lack of savings, our lack of capital investment. All of this is a byproduct of artificially low interest rates and huge government budget deficits and a tax code that encourages a debt. And so, what we should do is dramatically cut government spending, including on entitlements. We should allow the Fed to raise interest rates substantially so that people start saving again and stop buying stuff using credit cards. And, we need to reinvest because if we're going to have factories, where is the money going to come from to build them? Right? Foreigners are not going to build factories for us. See, that's what Trump is saying. If we impose tariffs, the rest of the world is just going to rush over here and build factories. No, they're not. They're not going to build factories over here. So we need to build our own factories over here, but we don't have the money to do that. And so we have to free up our resources by cutting government spending and and raising interest rates so that Americans will stop spending money and they'll save money instead. See, the reason that the Chinese have all the factories is because the Chinese people save their money. They don't spend like Americans, right? They save money, and their savings are invested in factories and the supply chains and the infrastructure. So we need to do that. We haven't had to do that because China's been doing it for us.
They did also get a big leg up though, didn't they, in the 90s and the early 2000s? I mean, anyone who would go to Harvard, from what I understand back then, and do an MBA, they'd be taught that what you need to do with your business in the US is take all your factories over to China. And really, with the amount of level of investment that we've seen from the West over into China, uh, surely that was really the main cause of that, though, wasn't it? It was actually really more about trying to increase profits in Western countries, taking it over to that country.
Well, certainly US companies, we're in a competitive market and consumers want a low price. They want obviously high quality and they want a low price. So they look for some combination of the two. They're willing to sacrifice a little bit of quality if it means a much lower price, right? And so businesses have to respond to the competitive pressures of the market. And so if you have a US company that wants to stay competitive, even with other US companies that are moving their production, let's say to China, well, then you've got to move your production over there too. Because if moving production to China means that you could lower your prices, well, you're going to get more market share. But now your competitors, in order to preserve their market share, they've got to do the same thing. So there was a lot of pressure on US companies to invest in China because factories there were much more productive than factories here, right? Because the cost of operating those factories was a lot lower. Even if you factor in having to ship the goods, across the Pacific Ocean, which obviously if you build a factory, here in the US, the goods are here. You don't have to ship them. You just put them on a truck or something or a train. But if you ship them, you make them all the way in China, they got a long way to go. But even with that, based on other costs, labor costs being one of them, regulatory costs, taxes, um, you know, environmental or other type of regulations too, or it was just so much more efficient to have the factories over there. And I guess they were also closer to the supply chains that were needed. Um, so these relationships, these investments have been going on, for better than 20 years, and so it's very difficult to try to reverse it.
No, I agree. It's really hard, isn't it? And it's all I wonder though is obviously I completely agree. The US is completely overspending, and they do need to slash especially government spending and commitments down the line. It's just getting out of control massively. But without that incentive, say I don't know whether tariff is the right way to go about it, but say without that added incentive of the tariff, what's even if you did get your house in order in the US and you were able to encourage savings and encourage investment in the US, why would companies do that if they could still make it cheaper elsewhere and then just import it into or sell it into the US and cut out the labor cost?
If we did the right thing, the cost of manufacturing in the US would come down. So that would be part of it. I mean, if we did the right thing, the dollar would actually fall, because the world has been supporting the dollar so Americans could keep buying their products. But if Americans aren't buying their products as much, then they don't have to prop up our currency. So they no longer have to lend us money so they can sell us stuff. But I mean, this whole vendor financing scheme was going to collapse eventually. Right. So you can argue that, well, let's prick our own bubble, which I would prefer to do. But the tariffs are not the best way to prick it. In fact, they're not a good way to prick it at all because, see, the tariffs are not going to bring industry back to America. What the tariffs will do is reduce our trade deficits because we will import less. But we may export less too. So it may not, because the problem is a lot of American companies that still export, rely on foreign components that they have to import. And if the cost of those imports goes way up, then their own products become less competitive when they're exported. Um, so tariffs just go after the symptom. The trade deficits are bad, but they're a symptom of the underlying problem that is leading to the trade deficits. So you can't just say, oh, let's attack the trade deficits with tariffs. That's not going to make American industry more competitive. In fact, if anything, it will make American industry less competitive. Our problems are just going to get worse despite the tariffs.
How much do you it's something that I haven't actually spoken about in a while, but when Trump was doing the campaign rally and coming into office, he was talking about this drill baby drill and getting oil prices a lot lower. How much, obviously, compared to the UK, for example, gas prices, electricity prices in the US are super competitive compared to us. I think you're a fraction of the cost. But how much does that policy allow you to weather the storm of some of the impacts that we've already been seeing with the policies that Trump's brought in through tariffs and whatnot?
I mean, oil prices have come down all over the world. In fact, they're coming down more in Europe because of the weakness in the dollar. Um, but oil prices have come down because the markets are factoring in a massive global recession, or at a minimum, a slowdown, a significant slowdown, and a lot less, you know, transatlantic, trans-Pacific trade. And so that means that there's going to be less demand for oil. We're not going to be, moving as much merchandise around, and the economy is going to be a lot weaker. And so that's what's caused the price of oil to come down. Now, sure, yes, that is a bit of a benefit to somebody who just needs to buy oil to drive their car, but they may not need to drive as much if they're unemployed. So it might not be as big a benefit if they're just sitting at home. But yeah, I mean, this is what's happened. But I think this is temporary because I do think that in this recession, we're going to get a bigger drop in the dollar, which will push oil prices up. And I don't think this is going to be a global recession. I think it's going to be mainly a US recession. But I think the rest of the world, especially the emerging markets, are going to benefit from a weaker dollar, especially if it's a much weaker dollar. And so I think that will lead to significant increases in energy consumption in those countries. And so I think the net effect will be to push oil prices higher.
Yeah, I wouldn't mind going back onto the topic of gold, and like, I wouldn't mind getting your thoughts on what's underpinning its value at the moment, because I think over the last couple of years, obviously we had COVID, we saw a really nice bull run during that period, and then during straight after we saw the Ukraine war, then we saw tensions in the Middle East, and then we see trade wars and whatnot. How much now? I guess all of this is all bubbling up and accumulating, but for example, this minerals deal with Ukraine and an idea of peace in Europe and a settling down of tensions in the Middle East. How much of that fear factor that sometimes gets priced into gold is still there, or because it seems like there's so many other factors that are just as important now underpinning why gold should
Yeah.
be as high as it is.
I mean, I think the biggest driver for gold really has been central banks understanding that the dollar's days as the reserve currency are numbered. I mean, nobody knows exactly how large that number is, but they know that it's getting smaller every day. And central banks need to replace dollars with another monetary reserve. And the best choice is gold. And that's what's happening. You're seeing central banks accumulating more gold. They still own a very small percentage of total reserves in gold. And so they have a lot of currency reserves to divest, predominantly US dollars. I think it's mostly US dollars that central banks want to get off their books and replace with gold. But I think eventually investors, both in retail and institutional, are going to figure out what's going on, and they're going to want to do the same thing. They're going to want to replace some of the bonds or fixed income that they have in their portfolio and put gold there instead. And so I think the investment demand is going to grow dramatically over time for gold, and I think central bank demand is going to continue to grow. And so the price, I think, has really no place to go but up. Doesn't mean it can't, go down along an upward trajectory. like, we pulled back. We almost got to 3,500 a week and a half ago, and now we're almost down to 3,200. But I mean, if you look at where we were a year ago, today we were, maybe 2,200. So we've moved up, $1,000. So gold is clearly moving up, and it's not just because of the trade war. I mean, it was moving up before the trade war.
Trump, in a throwaway comment, said he wished he could back the dollar against gold again. It just seems like something that's probably we're too far down the track now for that to ever really become reality. Or
Well, I mean, we could back the dollar by gold, but we'd have to raise the price of gold, the official price of gold, quite a bit in order to do that. But then, in order to maintain that backing, we'd have to stop all the deficit spending, which Trump doesn't want to do. I mean, Trump is one of the main reasons that Congress is going to pass this big, beautiful bill, which is actually quite ugly, and it's going to contain massive increases in deficit spending and a $5 trillion increase in the debt ceiling. We couldn't do that if the dollar was backed by gold, which is why it's not backed by gold, because politicians don't want to be disciplined. Uh, they were disciplined when we had gold backing, which is why our economy was much better under a gold standard than it is now. But now the government just can get away with murder. And so Trump could talk about it, but actions speak louder than words. He's not acting like somebody that wants to be on a gold standard. He's acting like a big spending liberal, or Democrat, Keynesian that's wants to prime the pump with inflation and government spending, and gold prevents that from happening.
changing topic one more time before I do want to go back to gold miners because I listened to you speak a couple of days ago about Newmont's profits and what's going on there, and it's just it's crazy how some of these majors haven't increased in value a bit more. But I wouldn't mind just getting your thoughts if you've had time to look into it on this Ukraine minerals deal. On the surface, from what I understand, they're not backdating any of the money owed, the 300 billion that Trump supposedly thinks they've given them. Um, and someone who works in mining, it takes a hell of a long time for you to explore, develop, build, and put these things in production. A lot of capital. It seems to me, if you were to offer the same deal to a junior mining company, we're going to basically upfront the cost and we're going to share the revenue after cost. I think most of them will bite your hand off for that deal. It seems like a better deal for Ukraine than it does for the US. Have you had a look at it?
Yeah, I haven't looked at all the details, but if what you're saying is that the United States government, is it the US government that's going to do it, or is it private companies?
It's fairly loosely worded. It seemed as though the US government was going to find partnerships to fund them, but this is where it gets a bit complicated because the US government is expecting 50% of the revenue. So I'm assuming the US government is going to front some of the bill of this.
Yeah, I mean, I mean, I would prefer private companies to go into the Ukraine and negotiate deals. I don't like the idea that the US government gets in there and tries to, become a middleman or something. It's obviously going to make it less efficient and more prone to, graft and corruption. Um, but yeah, I mean, I haven't looked at all the terms, but yeah, I mean, generally what happens, governments don't develop their own resources. When they do a lousy job. You know, generally what a country does is they will uh, uh, license through some kind of mining rights or a particular area to a private company, and that company will pay some override, a royalty to the government for that concession. And so the government doesn't do anything. It allows a private profit-seeking company to efficiently, mine the resources. So that's what I'm sure Ukraine. I mean, when you try to do it, when the government tries to go in and operate the business, it does a lousy job. It's very inefficient, and so they don't end up with a lot of output from from the government-owned mines. You need private sector efficiencies and profit motives.
Yeah, well, you do need profit motives, and it seems like this is taking some of that out in a way because, like I said, the amount of time, a lot of these resources aren't sort of JORC compliant or NI 43-101 compliant resources in the ground. It's US Geological Survey estimates, and there's a lot of work that needs to go into this. But anyway, it was just a comment to see if you had a view on it. I really want to talk to you about what you're doing in terms of Euro Pacific and the fund at the moment. I think I heard you speaking a few days ago saying that you're sort of quite highly weighted on more of the junior side of the market. That's where you're seeing most of the upside on the gold side. And but you obviously still hold in majors. The juniors haven't moved as much yet. I think the GDXJ is up roughly around the same as the GDX, but I'm looking anecdotally at a lot of different stocks in the junior space, and they haven't had a lot of movement.
Yeah, if you look at the GDXJ, there's a lot of pretty big companies in there. I mean, for the gold space. I mean, it's not like the gold companies are small in comparison to, your typical, let's say, US Fortune 500 company. Um, Even the seniors are pretty small market cap. But the juniors that we're overweighting in our portfolio are much smaller than the average GDXJ company. And and they've gotten even less love. But, the thing is with these stocks, you really need to accumulate your positions over time, because there's less liquidity there. And, if you go in a big way, you could be moving the price. So we have devoted, resources to accumulating these positions. And yeah, they haven't moved up nearly as much as the big stocks that we own. And we still participate in the gains from the bigger companies. But because we have this overrating in these very small country companies, it's caused our performance to lag. But we're willing to do that, make that sacrifice for the long-term gain. Because I think once we really start to see money coming into this sector, which hasn't even happened. In fact, retail investors are still pulling money out of the sector. I mean, they've been liquidating GDX and GDXJ every day this year, basically, even as the stocks were going up, the gold stocks. So, but when the investment flows reverse, when Wall Street wakes up to what the central bankers obviously already know, and we start to see a real re-rating of the gold sector, and a lot of money that has no allocation right into gold starts coming into gold, a percentage of that is going to want to go to these smaller stocks. And then they're really going to move. Those stocks are going to way outperform the bigger stocks, which is why we own them now. And so we're sacrificing short term performance because we know if we're right on what's going to happen in the long run, we're going to have huge outperformance. And if we just waited for these stocks to really move to then try to buy them, well, we couldn't get anywhere near what we own. We have good positions that we would never be able to accumulate if we had to compete with everybody else trying to buy the same stocks. So we're just waiting, and then we expect to have big outperformance. And at some point, we'll probably lighten up on these stocks, and that's where some of the liquidity is going to come from. When everybody else wants to buy these stocks, well, we'll be able to sell some, right? And so I think that for investors to get into our fund now, I think they're getting a great opportunity because they're really buying in a portfolio that they really couldn't build because it took us so long to buy all these stocks. And a lot of the stocks we got in private placements. We couldn't even get it in the market. We had to wait for the companies to need money, and then we provided it, and they got stock. And we also get warrants, and those warrants don't even get really valued in the in the whole NAV. So we've got a lot of warrants like in our back pocket that are really not being valued at all. That could all of a sudden be worth a lot of money.
One of the theories that I always hear in the industry is, well, what we need to see is a re-rating in the majors, and then we'll see a re-rating in the mid-tiers, and then the money will eventually start flowing down into the junior side. Is that a theory that you believe? Is that sort of what we're waiting for?
Yeah, I mean, I think that we're gonna have, um, a re-rating, and then I don't the market isn't gonna just crush these stocks. Like, look at Alamos Gold's earnings came out today. They were on the low end of, estimates, but, they mentioned that, with the recent big drop in production costs, with oil prices crashing, and they're expecting to increase their production, and gold prices are much higher now than they were last quarter, that even though they're at the low end of this quarter, they're still likely to meet their full year guidance and probably going to beat it. But at one point today, the stock was down 18%. I mean, now it's down 10%, but even that is a lot. I mean, it wasn't like a horrible earnings report. It was still, it was still earnings growth, but the market, The stock is now trading at where it was when gold was 2,800 a couple of months ago. So why should the stock lose, all the gains from 2,800 to 3,200 and change, $400 extra because it's ridiculous that the market reacts so badly to a miss. I mean, they actually finally, shares a new gold were up almost 20% yesterday. They had a beat. It wasn't even that big. So that was like the first time in a while I've seen a gold stock actually go way up when it beat earnings, because there's been plenty of them that have been beating earnings and the stocks have barely benefited. I mean, look how little Newmont went up. It had a very substantial beat. And the stock was barely up. And of course, now it's way below where it was when it beat those earnings. But because people still don't believe in the sector. The skepticism is off the charts. My guess is that most people think that gold's going to go back down, to 1,500. They never expected it to get to 3,000. They thought 2,000 was the top. So they have no idea why gold is going up. They just assume it's a fluke. And I've heard now people call the gold as like a meme coin. Like, yeah, I mean, like it's people just gambling on it when they're not gambling on it. Nobody is gambling on it. That's the point. People are gambling someplace else. They're not gambling in gold. The central banks, when they buy gold, they're not rolling the dice. They're buying it for a legitimate purpose. They know why they're buying it, and they're not going to stop.
Yeah, I just get the impression now that gold is up above 3,000, a lot of people think gold's expensive and they don't really see as much of the upside on the retail side anyway. That's sort of a perception
Yeah,
I'm
they thought
having.
the same thing at 2,000.
Well, exactly.
Yeah,
Yeah.
the the
Yeah.
the the major like, the investment houses were downgrading, Newmont and Barrick when gold was at 2,000 because they were saying there's no more upside in gold. They said gold is at the top, it can't go any higher. That was their thoughts, and, now and here we are 50% higher.
What would you see a appropriate performance? Say, for example, with Newmont, I think they had what, around 127% increase in profit in the last quarter. Absolutely smashed analyst consensus. And year to date, they're up 33%. What would, I don't know, in a rational world where perhaps there isn't so much disdain for these mining stocks, where would you say we'd need to get to in terms of an appreciation level where you'd say, okay, we are finally starting to see some momentum. How much more inflows do we need to start seeing into funds?
I couldn't say exactly where the price should be, but, I mean, it's trading at about 11 times earnings, and the earnings are growing pretty rapidly, and I expect the earnings to continue to grow. Um, you know, it's trading at a market multiple of about half the S&P, right? Newmont is the only gold mining stock in the S&P 500, but it's trading at about a 50% discount to the S&P 500, even though its earnings are growing much faster than just about any stock in the S&P 500. So you have to have a very pessimistic outlook on the future of gold mining to think that this stock is only worth 11 times earnings. When you're paying 20 times earnings for the rest of the S&P.
How much does sort of the tariffs and the uncertainty put a pause on an uprate into non-producing assets? And the only reason I ask that is because usually one of the things that people look for with the junior side of mining, so sort of development exploration stories, is when they start seeing major and mid-tier companies really go on an M&A spree, and investors, retail investors, get confidence that one of their picks is going to be one of the next ones that's going to get chosen.
Yeah, I mean, what I think is gonna happen once this sector really catches on fire and companies are getting a lot of, investment flows, these companies, the major big companies, right, they haven't really developed a lot of projects to replenish the reserves that they're now mining. Now, obviously, as the price of gold goes up, that unlocks some more expensive reserves and enables them to get more from the mines they have. But they're going to start looking forward 10 years, 15 years from now and think, okay, well, what are we going to do for earnings then? Right? We need to go out and develop some new mines. Well, the best way to do that is just to buy up some of these smaller companies that already have those projects in early stages of development. because they already know they're viable. They've been proven. They just need to be developed, and all that requires is money. Well, they have tons of money because they're making money like crazy, selling gold for whatever they're selling it. And so I think you're going to see a lot of consolidation in the industry. And I think like a lot of the small companies that we're buying and that we own in my gold fund, I think those companies will end up getting bought by these bigger companies that I also have in my fund. But they're going to buy these companies. So instead of selling them to other investors, we'll just sell them to gold mining companies because that's the low hanging fruit, right? Rather than trying to start from scratch, exploring for gold deposits, why not buy up the ones that you already know exist, right? So that's going to happen. Again, if people want, my fund, you could buy it. EPGIX is the ticker symbol for the no load version. So people can get into the fund at any of the discount brokerage houses. Look for EPGIX, or you can go to my website at Europe Pacific Capital, europac.com, get information on the fund. And you can even buy the fund. If you don't have a brokerage account, you could buy it directly from us.
Interesting. Okay. Just another thought on that in terms of the M&A activity. Obviously, after the tariffs, after this Liberation Day, one of the things that we're hearing in the industry is that sort of a lot of M&A is being put on pause just for a little while until certainty comes back. Um, does this put a bit of a lag on when we might start seeing sort of that love and appreciation start trickling down? And um, I guess I guess every day or every week there's uncertainty. At what point do people need to sort of just live with it and and start cracking on with their own business again?
You're talking about where in the mining industry or just in general?
In the mining industry, yeah. So one of the things that I've been hearing is that when you have so much uncertainty, it's hard for businesses to make big decisions. So doing M&A, but you doing deals sort of gets put on hold, and so that's a common theme that I'm hearing currently.
I mean, there could be some skepticism or some, concern in the industry about, where the price of gold should be. Maybe it's temporarily elevated because of all this uncertainty. But I think again, the trend is going to be up in the price of gold, even if the uncertainty dissipates and we have some kind of more a clear view of what's going to happen with tariffs. So I think ultimately, these deals are going to get made in the mining sector because what's happening in the global economy is going to be good for gold because what's happening is bad for the dollar. Trump wants to change the global trading system. He wants to rebalance trade so that the U.S. doesn't have these massive trade deficits. Well, that's going to mean a lower dollar. I mean, that's just what it means. And in fact, when you have Scott Bessent saying that one of the reasons that foreign countries are benefiting and they're cheating is they're undervaluing their currencies. So he wants the currencies of our trading partners to go up to level the playing field. Well, if those currencies go up, then the dollar has to go down. And so if you're a central bank and you're sitting on a lot of dollars and you know that even the US government wants those dollars to go down, well, why are you going to go down with that ship? Right? You're going to want to get rid of your dollars to own something that's not going to go down. And of course, if the US is going to run smaller trade deficits, that means the world is not going to have to reinvest as large a trade surplus in US dollars, in US treasuries. And of course, if the US is going to have smaller trade deficits, the main reason for that is because the US economy is in recession. We're not buying as much. That's the only way to really address it right now is if Americans reduce their consumption. Well, if Americans reduce their consumption and GDP is 70% consumer spending, we're in a recession. And what's the Fed going to do in a recession? Cut rates, making holding dollars even less attractive. And what are we probably going to do? QE. So now we're going to print even more dollars that are losing value. And so all this stuff is good for gold because it creates a more pressure on everybody who owns dollars to get rid of them. And what do you want to buy? Gold is the obvious alternative because it's not like Europe doesn't have any problems. It's not like Japan doesn't have any problems. And so all these other currencies, they're flawed too. Now, they may not be as flawed as the dollar, but why just substitute one flawed fiat currency for another? Why not just have gold, right? It doesn't have any of those flaws. And so that's what more central banks are doing. They're just buying gold. And then, nobody can sanction you. When you own gold and you have it in a vault in your own country, no other government can do anything because you own that gold, right? So they can't do to you what the U.S. did to Putin, because they were foolish enough to have a lot of U.S. dollars and a lot of U.S. treasuries, and that was the message we sent. If you hold a lot of U.S. treasuries, you're a fool because you've put yourself in a vulnerable situation that we could take advantage of.
Yeah, it's funny, isn't it? How even a few years ago, the US dollar was considered the least sturdy shirt, and sort of how that's flipped now is incredible. But no, to be honest, I think that might be the best sort of explanation as to sort of the upside of gold I've actually ever heard. So Peter Schiff, thank you very much for your time.
My pleasure.